Unit 3, Business Finance, Task 2. In this task, you need to be able to explain the use and purpose of business documents, discuss the components of several business documents, analyse the importance of recording financial transactions, and compare wages and salaries as methods of payment. So, if we look first of all at the writing frame for this task, you can see that you are going to have to look at several business documents. You are going to have to create your own, label key aspects, discuss who creates it and what it's used for, and discuss when Henry may use a document. Okay, so that's what we're thinking about, and that's what we need in the back of our mind when we think about the different, or when we start learning about the different documents that businesses use. So let's look at these one at a time. When you buy something, you go in the shop, you pick up what you want, you go to the till, you pay your money and you walk out. So all of the transactions happen at the same time. But when businesses are ordering things, quite often they're ordering things in advance and wanting them to be delivered. They might be buying things that you can't get off the shelf, you have to order them. And they might be ordering quantities of things that they just can't pick up by wandering into a warehouse, for example. So they use a purchase order form to place the order in the first place. And a purchase order form, first of all, says who is going to be to. Okay, so we can see this one is to Computer Supplies in Hightown. This will be the supplier number that the customer has given them, and this will be the customer's order number. And the customer's placing this order on the 6th of June 2002, and they're requesting it to be delivered on the 10th of June. Okay, so that's who's signed this purchase order, and this is what they're trying to order. So you can see this goes back a little while, trying to order packs of floppy disks. So the idea of this is it tells the supplier what the customer wants to order. Once the supplier has received the purchase order, they can then start processing that. So starting to get those products together, and when those products are all together and ready for shipping, they create a delivery note. And the idea of the delivery note is that it tells the customer what has been sent. Now that's really important, because sometimes an order might not be delivered in one go. So it might be that they've ordered 50 floppy disks and only 25 are going in the first delivery. So the customer needs to know that that's all that's been sent in that delivery, so that they know that they're going to get another delivery later on. They don't just think that the supplier's missed it off. So Jones and Kelly, here we go, a delivery note's going out to them. We've got their order number, we've got a customer account number, dispatch number, invoice number we'll come on to in a second, and how it's going to be delivered. And we can see they're delivering that whole of that first purchase order. So this is a piece of paper that goes out with the delivery, telling the customer what's been delivered. A goods received note is a note that goes back from the customer to the supplier saying this is what we have received, and it will be this note that they'd use to report any damages. So if any of those floppy disks have been damaged, for example, they might reject some of those and say these are damaged, and send them back. So that would be what a goods received note might be used for. Okay, so we're saying, here we go, Computer Supplies, delivery note. Okay, David Evans has done the checking, and we're saying there's one box damage with items missing, so they're reporting a problem with the delivery. And then a supplier could act on that, okay, and we'll look at the actions that they might need to take. Okay, so goods have been ordered, goods have been delivered. So we've had a purchase order, a delivery note, and a goods received note, which tells the supplier what they've received. But we now need the supplier to ask the customer for payment, and they do that through an invoice. Okay, so we can see here's our two lots of floppy disks. Okay, we can see our VAT at 20%. Okay, and we can see the total amount due. Now usually with invoices, customers get some time to pay, and this is where we would see this terms. Okay, so the terms net 28 days, so it means you have 28 days from the date of the invoice in which to pay. So this will be the supplier requesting payment from the customer for the goods that they have delivered. Now as we had one box delivered damaged, okay, the customer wouldn't pay for those, so they would expect a credit note. Now you wouldn't get a refund because when you've received the goods you haven't actually paid, so it would be inappropriate to have a refund when you haven't actually paid anything in the first place. So they would get a credit note. You can see this goods faulty, credit note for one lot of Daitech discs. Okay, they were reported missing, and this is the credit note saying basically we don't expect you to pay for these discs. So they would put that against the invoice. Okay, and they would take that $15.59 off the invoice and then pay whatever the balance was, and that would be easy to see on the statement of account. Now usually a statement of account would be sent, perhaps every month for regular customers, or it might be sent every now and again to remind customers to pay. So here we can see we've got an invoice due here. Okay, so that's what they owed at the 1st of June, they owed £70. Then there's another invoice here, £30.52, so they now owe £100.52, and we've got the cheque that they've paid, and then we can see that credit note coming off as well. Okay, so they're saying you now owe us £15.26. And this is useful for the customer because they can check that the invoices they think they've paid have actually been paid, and they can see that the credit note has been taken off their account in terms of what they owe. So statement of account shows customers what it is they owe and shows all their transaction history with that supplier. So usually on the bottom of a statement comes a remittance advice, and this is sent back with the payment telling the supplier what invoice they're intending to pay. So if you see here, we'd say amount enclosed, cheque number, your reference, date of payment, okay, and we're saying what invoice we intend to be paying, so that's where we'd put in your reference. So we could say we're paying, against the invoice for the 2 boxes of floppy disks. So the supplier can match up payments to the correct invoices that the customers owe. And we might pay by cheque. So cheques are kind of going out of fashion. Not many shops accept those now, but cheques can still be used, and probably would still be used by a business like a DJ business like you and Henry are using. It's an easy way of paying for things. Obviously you can do debit cards and credit cards, but that requires the business to have one of those chip and pin devices, and that costs a lot of money. So chances are you and Henry wouldn't have one of those, so you would accept cash or cheques. And often people don't like carrying around hundreds of pounds of cash. They would prefer to write a cheque. So a cheque, we have the date the cheque is written, we put on the first line who we're going to pay, and we add this line afterwards so that people can't write anybody else's name in there. We write out the amount that we want to pay in words, and we write the numbers here so we've got a cheque between the two, and we write sign here. Okay, and we can take that into the bank then, and we can use that as a method of payment. If you did pay by cash, you might expect to get a cash sale receipt. And you and Henry might issue these in your DJs when, if you have customers pay you by cash, they might want a receipt. If it was a, kind of a business function, they might want the receipt to prove that they've paid, and they might, need to show that to their line manager to show what they've paid cash for, and prove they have actually handed over the money. So there's your cash sale receipt. I'm not going to go into too much details there because we see receipts every day. Okay, so that's all the documents that you need to know about. So if we go back to the writing frame now, this is what we've got to do. Okay, so we've got to look at purchase orders, delivery notes, goods received, invoice, credit note, statement, remittance advice, cheque and cash receipt. Now for pass level, you can use these specimen documents that we've just been going through and change the details. If you go and click on them, you can see you can go and edit those. You have to create your own documents. So for pass, changing these is fine. If you want to get above a pass, you really need to be creating your own documents. So you can use some of the templates in Word. So you see there's an invoice one, if you have a look through some of these, you might be able to find some. Okay, there we go. So purchase and sales orders. Okay, if we go back on that, we've got sales invoices. Okay, so you can go and have a look at some of these. You might be able to find some templates in there. Otherwise, you need to have a look at the textbook and get some examples, or kind of create your own using the information that's on these slides. Just create your own so they look different. So for PASS, it's okay for you to just change the details that's on these. Okay, so just change the name and addresses, the products, the quantities, the dates. Just go and change all of those. Okay, and you can use those documents. For Merit, you need to find your own documents. Okay, so you create your own document. You label the key aspects of the document. So that's basically a screenshot of your PowerPoint. So from there, we'd take a screenshot and we'd identify all of the different elements. So the address, the supplier number, the order number, the date. You need to tell us what they are. Okay, so you'd label all of that. Okay, that's your first two. Then you discuss who creates it and what it's used for, and discuss why it would be useful to Henry. So that's looking at one paragraph really. So this first section isn't lots of writing, or it probably will be lots of pages, because you're going to have those documents screenshotted into your Word document so you can show what they're all about. So you need to take screenshots and put these into your Word document. So that's going to take up quite a lot of pages, but hopefully won't be too much writing. Okay, we've then got to explain how we use some of these documents. Okay, and at the end we get on to looking at recording financial transactions. So we're just going to have a look at that now. Okay, so a purchase day book is a record of what a business spends money on. So we'd have date, supplier, invoice, VAT, and then here we've got some categories of what that money's actually been spent on, and you can see we've got some totals as well. So a purchase day book shows what a business has been spending money on. A sales day book shows what sales they've done in that day, or what sales they've done in that week or month or year. So it records the sales, the money they've received from their customers. So, okay, we can see on here we've got, appropriate for a DJ, we've got money received from Mr. Catridge, from Amanda, Miss Keane, Kevin and Diane, Jonathan. We can see invoices that they have paid. Okay, and we've got details about excluding VAT, with the VAT, how much the VAT is, and including VAT. So we've got all our details there, and that's saying what money we've received from our customers. And we keep both of these as a rolling record. A cash book will show what money has come in and gone out of the business. Okay, so in the red we've got credit, cash out, things they've spent money on. On the left, we've got in black money that's come in, cash in. So we've got details and we've got a running total there of what's happening in terms of money in our bank. Okay, so that compares with the dates. Okay, so you can see here with all these transactions happening the first part of March. Okay, and then we've got the 20th, 21st, 26th, 27th. Okay, so we're looking at those transactions in the bank, kind of adding to or reducing the money that we've actually got. So that's our cash book, tracking money into and out of the business. You and Henry might want to use budgeting to keep track of what money you are spending and what sales you intend to, or what sales you're targeting to achieve. And you might use a budget that would be similar to this. Now a budget you've perhaps used in the past. You might have had a budget of how much you're going to spend on Christmas presents, or a budget for how much money you've got to spend in your summer holidays. It means you've got kind of a target of what's the maximum you would want to spend. Okay, well, when we apply that in business, we can use it not only for spending but for sales and profit as well. And basically we say this is what we would like to achieve. Okay, we compare that to what we actually have achieved, and then we can calculate our variance. So a budget for sales, we'd be looking at what value of sales would we like to get in January. So we would like to get 4,800. We actually got 4,000. So we were £800 down in terms of our sales in January. We've got 800 less than we would like. Spending, We'd like to spend just £450. We've spent £500. We're £50 over in terms of our spending. So what that means for our profit is we're £850 less on profit than we hoped we would be. Okay, so you and Henry could use this budgeting to keep track of how much money you expect to receive and how much money you expect to spend, and so how much profit you think you're going to make in each month. So very, very final part then, difference between wages and salaries. I don't know why this seems to be plonked on the end of this task, as it doesn't to me feel as though it flows on, but never mind. So we've come across this before. Wages are when workers are paid per hour. So the more hours they work, the more money they get. So here we've got a worker being paid £5 an hour, works 37 hours, so in a week, so they get £185 in that week. Okay, so that's how many part-time people are paid. So if you get a part-time job when you're 16, that is probably how you're going to be paid. A salary is when people are paid 12 equal monthly payments, and their pay will be the same regardless of the number of hours that they work. So, for example, a teacher gets paid the same amount of money every month. So obviously we do a lot more work in September than we did in August, but we get the same amount of money because we're paid a salary. So if we get a salary of £25,000, for example, 25,000 is what they would earn in a year. If we divide that by 12, we get how much money they earn per month. So we've got two different methods of calculating pay. So if you have a look, you've got some questions here about daybook and purchase daybook, sales daybook and cash book. You don't have to create your own of those. You can use and label the ones on the PowerPoint. That's for pass, merit and distinction. You don't have to create those documents. Okay, budgets. You don't have to create yours. You just have to explain, label it, and then explain how it could help Henry. And finally, you have to discuss the difference between wages and salaries. Okay, so hope that's helped you, and good luck getting this task done. Thank you.